Newton told us in his law of motion that if you have an object and you place the object at a particular point without moving it, that object is going to remain at that point, except somebody comes and moves the object from point A to point B. So in this video, I want to explain to you what moves the forex market. Something definitely will move the forex market. The forex market does not move on its own. There are certain things that makes the forex market to move, whether this is up or down or middle. And the forex market is always moving. So this is what I'm going to talk to you about in this video. The forex market, where currencies are traded globally, is influenced by a dynamic set of factors that cause exchange rates to constantly fluctuate. Understanding what moves the forex market is crucial for traders to make informed decisions and capitalize on opportunities. These factors stem from economic indicators, central bank policies, political events, market sentiments, and actions by large investors. In this video, I will explain to you the main drivers behind currency price movements in simple terms. Number one of these main drivers is economic indicators. Economic data releases are among the primary factors impacting currency values. They provide snapshots of a currency's economic health and outlook and future outlook, influencing investor confidence and demand for that currency. Now, one example of that is gross domestic product, GDP. GDP measures total value of goods and services a country produces. Strong GDP growth signals a healthy economy, attracting investment and boosting the country's value. Weak growth can weaken the currency. Another one is the inflation rate. Inflation reflects how quickly prices rise in an economy. Moderate inflation suggests a growing economy, but high inflation erodes purchasing power and can cause interest rate hikes to control it. Inflation directly impacts central bank policies and currency strength. Another major thing that moves the market, which is economic data, is employment data. Employment figures like the unemployment rate and non-farm payroll numbers shows the job market health. Strong employment growth indicates economic strength, often leading to currency appreciation. Another one is the retail sales and consumer spending. These figures indicate how much consumers are buying and their confidence in the economy, affecting overall economic growth and currency demand. Then trade balance is another one under the economic data. The difference between exports and imports influences currency values. A trade surplus, that is export greater than import, usually strengthens a currency, while a deficit weakens it. Now, most of these economic data, you can find them online on forexfactory.com. You can also find them on FX Street. You can find them on other major places, but the best one I know of is Forex Factory. And you will see the major news item. It will be shown in red. So at a glance in a day, if you're going to trade maybe the New York section, for example, or the London section, or any other section, you can see the news in red. Then you can mark the time and then target the time to know how to plan your trading. So this is how this information helps you. Now, apart from that, another thing that influences the price or the market direction or the market, another thing that moves the market apart from economic data is central bank policies and interest rates. Central banks play a pivotal role in forex markets by controlling monetary policy, mainly through interest rate adjustments. Just for information, I have a PhD in microbiology, but also have a certificate in insurance from the Chartered Insurance Institute of Nigeria. And I've worked in the insurance sector, in the financial sector in Nigeria previously, and this interests me in teaching you how to make money both online and offline. So I have other certificates that I've taking different courses online on different things to help myself and to help you. So as I was saying, another major thing that moved the market, as Newton's law of motion tells us, that something must move something. That if nothing moves something, that thing will remain at the same point. So another thing that moved the market, apart from economic data, is central bank policies and interest rates. Central banks play a pivotal role in forex markets by controlling monetary policy, mainly through interest rate adjustments. When a central bank raises interest rates, it attracts foreign capital seeking higher returns, increasing demand for its currency and causing appreciation. Conversely, lowering interest rates tend to make a currency less attractive because investors seek better yields elsewhere, weakening the currency. Apart from these interest rates, central banks may engage in quantitative easing or tighten money supply, also influencing currency supply and demand. Number 3 is political stability and geopolitical events. Political conditions have a strong influence on currency prices. Now, before I go on, I am making this video for free. Some teach this in some places and they get paid. Now, if you want to support me or you want to show me love, you can join. You can look below and you see the join. Click the join and you can give out some money. Maybe once in a month, every month, you click join and then you pay some amount of money through your bank. And then you can use that to say thank you to me for making this video. If you don't have money, there's no problem, but if you have and you want to give, look at the join button in description and just below the video. So you find somewhere where I say join or something like that. Click it and it's going to give you more information and then you can support me. Now, political stability is another thing. They tend to attract investment, supporting a stronger currency. Then we also have political instability. Unrest or unexpected events such as elections, policy changes, or conflicts can cause sharp volatility as investors seek safer assets. Then we also have geopolitical tensions. Wars or sanctions also create uncertainty, often weakening the affected country's currency. So if let's assume that USD goes to war with Russia, is an example, what do you think will happen? The USD is going to be weakened because there's war. Many things that are supposed to go on in that country will be affected. So the country will weaken. So if at that time you are buying USD against JPY, you're going to be making a loss. So at such a time, you should be buying Euro against USD. Then you should be selling JPY. You should be selling JPY in the USD JPY pair. So that is how you do that. Now, another thing that move the market is market sentiment and speculation. Forex prices are heavily influenced by trader psychology and market sentiment, the overall mood or attitude toward risk. Positive economic news and investor confidence can boost demand for a currency. Negative news, fears of recession or global crisis lead to risk aversion, pushing investors toward safe haven currencies like the US dollar, Swiss franc, and Japanese yen. Speculative actions by large institutional investors and hedge funds can create short-term price swings based on perceptions and momentum. Now, number 5 things that moves the market in Forex is large investors and commercial activity. Now, let me explain again that when I say move the market, what I mean is that some market will just be ranging. It will not go up, it will not come, it will just be at a line like that. But what makes the market to go and come, go and come, go and come, which is when you as a trader can make money, when the market is actually making some major moves. What makes the market to make these moves is what you're looking at. Number 5 of these is large investors and commercial activity. By institutions big institutions such as hedge funds, banks, multinational corporations, and investment funds move vast sums and can influence can influence exchange rates. Their buying and selling activity reflects broader economic trends and investment flows. Then corporations use forex to hedge currency risk in international trade, affecting demand. Monitoring positions of these players, such as through commitment of traders' reports, can provide insights into market direction. Now, I need to conclude by letting you know that all these factors I've mentioned together, these factors continuously shift supply and demand dynamics in the global currency market. Traders who understand and monitor these drivers can better anticipate forex price movements and position themselves accordingly. Some years ago, there was a massive sale of XAU USD. Why? Because there was a fundamental news. So I kept on selling the XAU USD pair, that's gold, and I kept on making huge chunk of money. At that particular time, I was involved with some people who contributed money for someone to trade for the group. The person traded and was at a minus. So I was asking what is going on, because we are supposed to report back. They are supposed to report back every week. They didn't report back. After some time, everybody was bothered. So I was a strong member of that community, and I asked, and they told me in secret that, oh, they are making losses. So I took up the account, and that was when there was a fundamental news which I knew was going to favor the USD against the gold. So I kept on selling, and as I kept on selling, I moved the account from negative to positive, and everybody got back their money in positive. Now, please, I want you to subscribe to this YouTube channel, like this video, share the link of this video to family and friends, and keep coming back for more. The next thing I'm going to talk about is forex trading sessions and the best time to trade forex. So don't miss it as I talk to you about it. But before then, this video popping up by the side for my channel is the next one you should go out and see now. I will talk to you in the next one. Kemcho. Namaste. Udabo.